Imagine standing in a boardroom, $500 million on the table. Not imaginary, not theoretical. Real cash, real risk, real pressure. Zillow made a decision that promised to redefine real estate forever. Buy homes directly from sellers, flip them at algorithmically perfect prices, and dominate the U.S. housing market. It sounded brilliant, revolutionary, genius, and the world believed it would work until it didn't. Here's the shocking truth. It didn't fail because of bad ideas. It failed because ambition met reality, and reality always wins in silence. In the next 20 minutes, you'll see every calculation, every warning ignored, and every consequence that quietly accumulated to $500 million lost. And by the end, you'll understand why this isn't just a Zillow story. It's a lesson every founder, investor, and executive must see before they make the same mistake. Zillow didn't just buy homes. They built a machine, an algorithm designed to predict prices, demand, and timing better than any human ever could. It was flawless on paper. Executives trusted it like gospel. Investors cheered every acquisition. The media called it the future. But here's the brutal truth. Algorithms don't understand humans. They can't sense fear, hesitation, or sudden shifts in sentiment. They can't anticipate a market that behaves like people. Unpredictable, emotional, irrational. And when humans collide with perfect systems, chaos hides in the details. Zillow's algorithm didn't fail. It simply revealed a limit in control. A limit that would cost them $500 million. By mid-2021, Zillow went all in, acquire thousands of homes at top dollar, flip them fast, scale faster. It was ambition taken to the extreme. Every new home added risk. Every day delayed cost money. And every prediction carried real-world consequences. For outsiders, it looked unstoppable. For insiders, it was a silent countdown. And the most dangerous part? No one noticed the warning until it was too late. This wasn't a crash. It wasn't a scandal. It was a predictable collapse of confidence meeting reality. And soon, that $500 million would vanish. Not with a bang, but with the quiet weight of inevitability. By late 2021, Zillow wasn't just buying homes. It was buying the market itself. Thousands of properties across the U.S., hundreds of millions of dollars in inventory, a machine-like system that seemed unstoppable. From the outside, it looked like confidence, brilliance, a company reshaping an entire industry. But here's the hidden truth. Scale amplifies mistakes. Every minor miscalculation, a wrong prediction, a delayed sale, a regional downturn, didn't stay small. It multiplied, slowly, quietly, until it became impossible to ignore. The company that could have paused didn't. The leaders who could have questioned the system didn't. And the market that could have corrected itself waited patiently, watching as risk compounded. Signals were there. Small, quiet signals, almost invisible. Margins shrinking slightly. Some homes taking longer to sell. Unexpected repairs. For outsiders, nothing dramatic. For insiders, a whisper. Maybe we should pause. But when billions are on the line, whispers are drowned out by momentum. Executives rationalized. Investors reassured. Analysts celebrated. And the company kept moving forward. This is a trap most modern businesses fall into. Success hides risk and momentum silences caution. Then the numbers hit, not in headlines, not in dramatic reports, in quiet, relentless ways. Unexpected market shifts. Homes losing value faster than projected. Holding costs ballooning. The algorithm was still perfect on paper. But reality had a different equation. And suddenly, a $500 million bet wasn't a bet anymore. It was a burden, a risk too large to pivot from. A story that would make every CEO, every founder, every investor pause and ask, how do we not see this coming? This story isn't just numbers. It's humans. Executives making impossible decisions, analysts questioning quietly, teams working tirelessly under pressure. Every email, every call, every spreadsheet carried weight. Zillow's $500 million loss wasn't a failure of technology. It wasn't a failure of skill. It was a collision of human ambition, market unpredictability, and overconfidence in systems. And that's what makes it unforgettable, and what makes it a lesson every business leader in the U.S. must study. Because it's not about Zillow. It's about what happens when smart people with the best tools underestimate uncertainty. By now, confidence had taken over. Executives had data. They had patterns. They had models that seemed bulletproof. But there's a subtle danger in confidence. It silences questions. It erases hesitation. It convinces even the sharpest minds that the path forward is inevitable. Zillow's machine was perfect in theory, but the market isn't theoretical. Every small deviation, every local slowdown, every unexpected repair was a signal. Ignored because confidence is deafening. And the most expensive mistakes are often invisible until they explode quietly. The first signals weren't dramatic. A few homes didn't sell in weeks. Margins started narrowing. Unexpected repair costs piled up. Nothing catastrophic, nothing headline-worthy. But each signal was a warning whispered to those willing to listen. And the question every leader should ask is, when does slightly off become irreversible? Zillow's answer was, not soon enough. By ignoring these subtle cracks, momentum carried the company forward straight into its $500 million loss. Behind spreadsheets, algorithms, and acquisitions are humans. Managers reviewing contracts at midnight. Teams negotiating repairs under extreme pressure. Analysts watching data flicker and fade. Every lost dollar carried weight. Every delayed sale carried stress. Zillow's loss wasn't just financial. It was a lesson in human ambition colliding with uncontrollable reality. And it's why studying this story matters. The most valuable business lessons are never in successes. They're in the silent, painful failures that almost nobody reports. Every major loss has a moment, a single decision, a single pause not taken, a warning ignored. For Zillow, that moment was silent, invisible, and completely predictable. The algorithm kept buying. Homes kept accumulating. The market shifted subtly beneath them. By the time reality hit, it was too late. $500 million had already been committed, and no amount of optimism could reverse what had been set in motion. The lesson is brutal. The right decision often comes before the risk is obvious. So, what separates those who survive from those who stumble? It's not talent. It's not resources. It's awareness. The willingness to pause when the rest of the world says, go faster. The courage to question even a system that seems perfect. The discipline to recognize invisible risks before they compound. Zillow's mistake wasn't ambition. It was the assumption that speed and certainty were enough to conquer uncertainty. And that's a lesson every founder, executive, and investor should carry forward. Markets don't forgive overconfidence. Systems don't forgive assumption. People don't forgive oversight. There's always a moment in every major corporate failure when the exit quietly disappears. Not loudly, not suddenly, and never with a warning label. It disappears through accumulation. For Zillow, that moment wasn't marked by a single decision. It was marked by inventory, thousands of homes, each one financed, each one costing money every day it sat unsold. At small scale, mistakes can be corrected. At massive scale, mistakes become structural. By the time executives realized flexibility was shrinking, it was already gone. Because when you own that much inventory, you don't just slow down. You don't just wait and see. You either keep buying, or you admit the bet was wrong. And admission, at that level, comes with consequences. Market reactions, investor confidence, internal morale. So momentum took over. Not because leadership was reckless, but because stopping had become more dangerous than continuing. That's when exits disappear. Data is supposed to protect companies from emotion, but sometimes data becomes emotion. Zillow's models were trained on years of historical stability, years where prices trended upward. Demand stayed predictable, and corrections were temporary. But markets don't ask permission before changing. They hesitate first. They slow down quietly. They behave differently. Algorithms struggle with different because models don't detect uncertainty. They average it out. And when uncertainty is averaged, danger gets smoothed into optimism. The dashboards still look clean. The projections still made sense. And that's the most dangerous moment, when numbers still reassure you. Even though reality has shifted underneath, the data didn't lie. It simply stopped telling the full truth. Inside Zillow, something subtle began to change. Not panic, not chaos, silence. Meetings grew shorter. Questions became safer. Concerns were framed carefully, as hypotheticals, not warnings. This is what high-performing organizations do under pressure. They protect themselves from uncertainty by reducing friction. But friction is often where truth lives. When everyone senses risk, but no one wants to be the first to disrupt momentum, caution becomes isolation. And isolation is expensive. Zillow didn't lack intelligence. It lacked permission to slow down, because slowing down would have meant questioning the system, and questioning the system would have meant questioning success itself. Eventually, reality forces clarity. Zillow faced a decision, not between winning and losing, but between containing damage and allowing it to grow. The home buying operation was shut down, inventory was liquidated, losses were recorded, and just like that, the bet was over. But here's the truth most people miss. The loss didn't happen when Zillow exited. It happened earlier, when leadership believed there was still time to adjust. Time is the most dangerous illusion in business, because by the time time becomes visible, it's already gone. This story isn't about Zillow. It's about modern business. Today's companies are built on systems, automation, and predictive confidence. And those systems are powerful until the environment changes. The most dangerous belief in business is this: the system will tell us when something is wrong. It won't. Systems assume continuity. Markets thrive on disruption. Zillow didn't fail because it lacked intelligence or capital. It failed because it trusted models more than judgment. And right now, somewhere else, another company is expanding, acquiring, scaling, confident that the data will protect them, unaware that their exit is quietly shrinking. Here's the uncomfortable truth. Zillow wasn't the first company to make this mistake, and it won't be the last, because the mistake wasn't technical, it wasn't operational, and it wasn't even strategic. It was psychological. Every generation of business leaders believes they've finally built systems smart enough to eliminate uncertainty. Better models, more data, faster execution. But uncertainty doesn't disappear, it moves. It hides in assumptions. It hides in averages. It hides in confidence. Zillow believed it could turn a market built on human emotion into a predictable machine. But housing isn't just supply and demand. It's fear, timing, local sentiment, unexpected hesitation. And when uncertainty enters a system designed for certainty, the system doesn't break immediately. It drifts. And drift is the most dangerous form of failure, because it feels manageable until it's irreversible. This is why this story matters. Because today, across the U.S., companies are making similar bets. Automated lending decisions, algorithmic pricing, AI-driven expansion, model-based forecasting, all built on the same belief. The data will warn us in time. It won't. Data explains what was. Judgment prepares you for what might happen next. Zillow had world-class data. What it underestimated was how quickly reality can move once it decides to change direction. So here's the question this story leaves behind. Not, why did Zillow fail? That's easy. The real question is, where are you trusting certainty too much? Where is momentum drowning out caution? Where is success silencing skepticism? Where is a system being treated as infallible? Because the most dangerous moment in business is not failure. It's confidence without friction. Zillow didn't collapse overnight. It didn't implode. It didn't panic. It slowly realized it had already crossed a point where control was possible. And that's what makes this story so relevant and so uncomfortable. Most failures don't announce themselves. They accumulate quietly while everyone is busy celebrating growth. The difference between companies that survive downturns and those that don't is not intelligence. It's humility. The humility to pause. The humility to question. The humility to assume the model could be wrong. Because when the next market shift arrives, and it always does, the companies that survive won't be the ones with the fastest systems. They'll be the ones that recognized uncertainty before it demanded payment. And Zillow paid $500 million to learn that lesson. There's one final detail most people overlook in the Zillow story. After the losses were booked, after the strategy was shut down, after the headlines moved on, the real lesson still wasn't resolved. Because Zillow's decision wasn't unique. It was simply visible. Right now, quietly, confidently, other companies are standing at the same invisible edge, not failing, not panicking, not collapsing, just trusting models, trusting momentum, trusting that this time, the system will warn them early enough. And here's the uncomfortable truth. By the time the warning becomes obvious, the decision has already been made. The question is never will a downturn come. It's always who will recognize it before the cost becomes permanent. Because the most expensive business decisions are not the loud ones. They're the quiet ones, the ones made by default, the ones nobody questions, until the bill arrives. And somewhere right now, a boardroom is approving a plan that looks brilliant on paper, while the exit is already shrinking. If you want to understand how smart companies prepare before the damage becomes visible, before losses are booked, before strategies are reversed, before confidence turns into regret, then the next story matters. Because in the next episode, we're examining the companies that saw the warning signs and acted while everyone else was still celebrating growth. One document, one decision, one moment when everything could have changed. Most missed it, a few didn't. And that difference is where survival begins.